In this video, I'm going to show you how to account for a foreign currency borrowing. So let's say we have a company in the United States and their financial statements are denominated in US dollars and they borrow money, but they're borrowing in euros from a European bank and they promise to pay back in 1 year. So they're going to have to pay back in euros. They're getting euros. When they borrow the money, they're going to have to pay back in euros. So we've got some exchange rate info here. Now, when they actually borrow the money, all we know, so let's say they borrow on July 1st, 2020, and the exchange rate at that time is $1.10. So basically, if you had €1 and you were to convert it to US dollars, you'd get $1.10 in US dollars. We don't know this information at this point in time, but we're going to need that to solve the problem when I go to show you the example. But right now, so July 1st, 2020, we've got an exchange rate of $1.10 per euro. Okay, and then in terms of the amount borrowed, they're borrowing 800,000 euros at an annual interest rate of 10%. And so that's going to result in $40,000 of interest semi-annually. And I say semi-annually because they're borrowing on July 1st, and we'll assume their fiscal year ends on December 31st, and so they'll have to accrue some interest and so forth. You'll see that all in the sample problem. So again, borrowing 800,000 euros. They're going to pay it back, the entire amount back, plus interest in 1 year, but semi-annually they're going to incur, so every 6 months they're going to incur 40,000 euros in terms of interest, okay? Now, let's go and say, how would we actually account for that? Well, when they borrow the money, we're going to debit cash for $880,000, and then we're going to credit note payable or loan payable, something like that. Okay, so I've got note payable here, credit for $880,000. Remember, this is a U.S. firm, so their financials are denominated in U.S. dollars. Now, how did I get the $880,000? Where'd that number come from? So we got 800,000 euros that they're borrowing, and we're immediately going to convert that using the spot rate at the time of the borrowing, which is July 1st, 2020, right? That's the date here. We just borrowed the money. So we're going to take 800,000 euros times 1.1, and that's going to give us 880,000 US dollars. So even though they borrowed 800,000 euros, that's the equivalent of them borrowing $880,000. If they needed 800,000 euros to immediately repay the loan for whatever reason, it would cost them 880,000 US dollars. That is now the liability that they've incurred in terms of US dollars. So that's pretty straightforward. We haven't had, we're just going to get a little more complicated. We're going to have some changes in exchange rate. Okay, the exchange rate's going to change on December 31st when they go to accrue the interest. There's going to be a different exchange rate. So let's get into that. So when we accrue after 6 months, we accrue 6 months of interest. And again, that's 800,000 times 10% divided by 2. Okay, so that's where we came up with that 40,000 if you were curious. But we owe 40,000 euros. Now we have to convert that to US dollars. So 40,000 euros, but we don't multiply by 1.1 because now on December 31st, we're going to assume, or I'm telling you in this problem, in the case facts that I'm assuming, we're assuming that the US dollar is now $1.15 per euro. Okay, so it's $1.15 per euro. Of course, when you originally borrowed the money, you didn't know that there would be changes, but now we're assuming today is December 31st, 2020, and now it's 1.15 is the exchange rate. So we're going to take the 40,000 euros and multiply that by 1.15, and that gives us 46,000 US dollars. So we're going to debit interest expense of 46,000 and credit interest payable. So they're not actually paying the interest yet. They just incurred the interest. This is an adjusting journal entry. At the end of the loan, they'll pay off, they'll repay the principal and the interest. We'll get to that. But for right now, they incurred 40,000 euros that's half a year's interest. But when we multiply by the exchange rate, that's actually 46,000 US dollars of interest that they have incurred as a liability. Now, what do we do about the fact that the note itself? So remember, we borrowed, the note payable was 880,000. But between July 1st and December 31st, for this 6-month period, we said the exchange rate had changed. It went from $1.10 per euro to now $1.15. So how do we account for that? Because if we were going to have to repay the loan, now it's gonna cost us more in terms of US dollars. So what we're gonna do is we're gonna increase the note payable. We're gonna increase it by how much? Well, you say, okay, look, 800,000 euros, that's the amount we borrowed. That come back, that's the given information, okay? But now, so when we originally borrowed that and we converted to get this 880,000, we were using $1.10 as the exchange, but now it's $1.15. So we're going to take the difference. Okay, there was an increase of 0.05. Okay, so we're going to take $1.15 minus $1.10, the difference in the exchange rates right here, and we're going to multiply it by the amount that we actually borrowed, the 800,000 euros. So 800,000 euros times 1.15 minus 1.1 is going to give us 40,000. So in terms of US dollars, our note payable is increased because of the change in exchange rate. Now, what do you debit? Well, we're going to say we have a loss, okay, because our liability increased, so it makes sense. This is a loss, not a gain. And so now we're going to have this loss of $40,000. So now the note payable, if we had to pay, hypothetically, if we had to pay right now to repay the loan, forgetting about the interest for a second, we would have to pay $920,000, okay, in terms of US dollars. So now let's move forward, and let's say now we are at the end of the final date. So now it's been 12 months. So we're going to repay the loan. We're going to pay the interest. But we also have to account for the fact that we now had another 6 months of interest, okay? So we had the first 6 months of interest. We accrued that here when we debit interest expense, credit interest payable. But now we have to do that again for the next 6 months of interest. Now, again, we said semi-annual interest in euros is 40,000. So it's 40,000, but now the exchange rate has changed again. Now it's $1.25 per euro. Okay, so now as of July 1st, 2021. So now we're going to use that exchange rate. So we're going to say the interest, 40,000 euros times 1.25, that's 50,000. So this again, this is the second 6 months of interest. This is the interest from like January 1st, 2021 until this date here. Okay, so that's the second 6 months of interest. We now accrue $50,000 given the exchange rate in place at the time. Now, this is where it gets a little complicated. Hang on. The original The first 6 months of interest, which we already accounted for here. Remember, we said we're going to have to pay 40,000 euros. When we account for that and we incurred this interest payable, we did it at 1.15 as the exchange rate. But now it's changed again, right? We said it's changed $1.25 per euro. So this here is the second 6 months of interest, but we have to go back and revalue the first 6 months of interest to reflect the fact that we now owe more interest payable because of the change in the foreign currency rate. So we take 40,000 euros, the first 6 months of interest, times the difference, the change in the exchange rates, $1.25 minus $1.15. So that 40,000 times 0.1 is 4,000. So we're going to increase our interest payable. Basically, we're going to have to pay more interest in terms of US dollars because of the change in exchange rate, because it went from $1.15 to $1.25 per euro. Now, we have accounted for, so here was the second 6 months of interest, and here was the first 6 months of interest, us revaluing it to account for the change from $1.15 to $1.25. Now we're actually going to pay the interest, and we need a, so we debit interest payable for 100,000, and we credit cash for 100,000. If you say, hey, where does this 100,000 come from? Well, the 46,000. We originally recognized 46,000 of interest payable, then 50,000, and then we increased by another 4,000. So you add those three numbers up, and you get 100,000. That's the interest we pay. In terms of US dollars, we're going to pay $100,000, and then we convert that to euros and repay this bank. Okay, so it takes us 100,000 US dollars to do that. Now we've covered the interest. We paid all the entire year of interest. We're all set. We're going to repay the note. We're going to repay the note, but first we have to revalue the note because, again, between December 31st, 2020 and July 1st, 2021, the interest rates, or excuse me, the exchange rates have changed again. It went from $1.15 to $1.25, so we have to account for that. 800,000 is the amount we borrowed in terms of euros, 800,000 euros, times the difference in exchange rates, $1.25 minus $1.15. That's up. This is a catch up. What happened in the last 6 months? That's 80,000. So we need to increase the note payable by 80,000. So we're increasing our liability, and then we're gonna debit foreign exchange loss of 80,000. Okay. Now we're gonna go and pay the note. So we owed 800,000 euros, but what is that in terms of cash? Well, you can add it up and you can say, okay, look, we had our note payable was 880,000 initially, but then in US dollars, and then we increased it by 40,000. Okay, but then we increase it again each time we revalue when the exchange rates changed. It's not, if you add up 880,000 plus 40,000 plus 80,000, that's $1 million US dollars. Okay, so that's $1 million US dollars. So now we're going to pay $1 million US dollars. We credit cash and debit the note payable. So now we have, this is our repayment. We have repaid the loan. We've not only repaid the interest, we repaid the loan. Of course, now we convert to US dollars, to euros, and so we pay back this European bank. Okay, but now we've fully accounted for the repayment of the principal, the loan, and the interest.